global sentiment, risk management, capital management, arbitrage, and financial science filed under financial science, mosaic theory, too big to fails, Wall Street bailouts, Wall Street corporate culture, capital markets by stock exchange. Leave a comment October 10, 2010. Feel the passion of financial gladiating and witness the birth of our collective awareness of how present levels of technology can absolutely revolutionize the way we conduct our lives, and how we govern our diplomatic relationships with democratic global society and American capitalism. We would like our output to be as flexible about its input for our own sanity in performing quadrillion total bit calculations to arrive at optimized variables through both parameterized octagonal techniques related to the disproportionate scalar conversion fractal mathematics theoretically derived factors affecting the underlying volatility of the portfolio uniformly, over many iterations, should converge and be plainly scalar, meaning any combination of optimally allocated pyramidal combinatorial options can be taken into consideration and adjusted for that investor's and advisor's chosen counseled level of risk. My personal recommendation is a 5% target drawdown per contract, adjusted for portfolio drawdown to account for the effect of impossible theoretical log normal loss assumed generally in our commodity markets and futures markets, including those of precious metals, forex and bonds, and billions of dollars of other exotic instruments that benefit a few wealthy people, to be impossible. So the public liquidity preference means public-private equity trade doesn't ever happen without an active market and demand reinforced by the most recent pricing and fundamental information, which we should all be thankful that the debtor society we would have today, from the likes of Enron to the global economy, and all of the financial hardships from greed and financial injustice, not just from the corruption, including pumping and dumping and outward projection of confidence, shows that we all let our guard down when he walks up in a Ferrari and tells you about the $200 checks he just cashed for $20 million that he got and spent for formatting standardized proprietary reporting software to pay what clearly were excessive kickbacks, despite the obvious conflicts of interest in this arrangement. But if we really thought that Wall Street would not have paid them if they weren't actually making tangible profits in third-party portfolios based on that information, not just the image, hype and iconic style Enron gave eternally to corporate America. That's what led to our subsequent idolization of the wealthy, with rumors of the stories I doubt anybody would deny they never heard about how the wealthy became wealthy by further exploiting their relatively meritless fame with gossip from regularly featured random quarter-hour frames about great financial success, which is not simple to claim, especially for all of us that don't know what $1 billion is for. I plan to demonstrate why publicly by putting the spreadsheet mentioned here in various locations around the internet, and you'll see how the evolution of our financial system is determined by human projections desiring predictable, repeatable patterns entangling with all of our typically optimistic intentions, allowing for frequent friendly, attractive, opportunistic trading activity, usually as entries or trades placed in our individually opinioned, directionally hedged speculations that can always be priced when any public quotation auctions its change. So my